All right, Steve here. This is it, the finale of our Schwab Master Series. Today, we're getting into something I really love, how to trade the chaos itself. We're going to talk about profiting from big moves when you have no idea which way they're going to break.
It is Monday, March 9th, and right out of the gate, the S&P 500 is already down 1.3%. You can just feel it, right? The market is coiled, it's ready to spring.
And of course, the first question buzzing around is, which way is it going to go? Is it going to pop or is it going to drop? And you know what my answer is today? I don't care, not one bit.
See, today, we're not picking a side. We're not betting on up or down. We are betting on movement. These are what we call directionally agnostic trades. We're simply making a bet that the market is going to go somewhere, and go there in a big, big way. So, let's start with the classic, the heavy hitter, the long straddle. This is, well, it's the ultimate play when you're expecting fireworks, but you're just not sure which direction the rocket's pointed.
The concept here is brilliantly simple. You buy a call and you buy a put. Same strike price, right at the money, and the same expiration date. Now, if the stock absolutely rockets higher, your call prints. If it craters and falls through the floor, your put prints. Either way you move, one of those legs is designed to make more than enough to cover the cost of the whole trade. And the structure couldn't be simpler. You buy one at-the-money call, you buy one at-the-money put. Think of it like buying two lottery tickets for the same drawing. One ticket says up, the other says down. You're positioned for a payday no matter which number gets called. And this right here, this shows you the beauty of the risk profile. It's a V-shape. You make money if it goes way up, you make money if it goes way down. The only way you lose is if the stock just sits there, goes absolutely nowhere, and is pinned right to your strike price at expiration. It's why this is the go-to strategy for a binary event, like an earnings report or a big Fed announcement.
Okay, but let's be honest. A straddle can be expensive. That premium can be pretty steep. So what if you want to play for that volatility, but on a bit of a budget? Well, that's where its cousin comes in, the strangle. Now, the goal here is exactly the same as the straddle. We want to profit from a massive move. The difference is all in how we build it, and we build it specifically to lower that upfront cost. So with a strangle, you're still buying one call and one put. But instead of buying them at the money, you buy them out of the money. You pick a call with a strike price above the current stock price and a put with a strike price below it. Because they're further away, they are significantly cheaper. And here is the crucial trade-off. You have to understand this. The strangle costs less, absolutely. But, and this is a huge but, the stock has to move so much further just to get to your break-even point. You're paying a lower entrance fee, but you are demanding a much, much bigger move for the trade to even have a chance of getting into the green. All right, finally, let's talk about execution. Because having a great strategy is one thing, but getting into it cleanly and efficiently, especially when the market's moving fast, that's a whole other ballgame. This is where the pro-level tools come into play. On this platform, there's a tool called a custom stock opt. Now, what is that? It's a hybrid order. It lets you link a trade of the actual stock shares with an options contract, all in one shot, one single clean execution. So why is this so powerful? Imagine you're putting on a covered strangle. That's 3 different parts. You have to buy 100 shares, you have to sell a call against it, and you have to sell a put. Trying to leg into those one by one, you're exposing yourself to risk, to slippage. This tool lets you fire them all off as one single order. It guarantees that your hedge is on the instant you own the stock. It just completely eliminates that leg risk.
So let's just pull it all together. We've looked at 2 of the absolute core strategies for trading pure volatility, the straddle and the strangle. And we've looked at a powerful way to get them done. These are foundational concepts for any serious options trader.
But I'm going to leave you with this one thought, and it might be the most important thing we've talked about in this whole series. These strategies, these fancy order types, they are just tools. A high-tech platform is just a toolbox, but the best tools in the world won't make you a master craftsman. The discipline to use them correctly, that has to come from you. That's a wrap on our series. This is Steve. Remember your rules and always, always trade your plan. I'll see you at the open.